All right, welcome back to another episode of the the Black Bullion Show for Gold and Silver Today.com. Okay, so I'm going to break rank here with the opinion of someone who I tend to agree with on a lot of things regarding the economy. Now, a while ago, you may have seen a two-part, or I think it might be a three-part debate between Peter Schiff and Jim Rickards regarding many things on Kitco, including inflation versus deflation. Now, I'm one to believe that gold and silver help to hedge against inflation. I'm also one to not yet find fault in the quantity theory of money, which leads me to my conclusion that we indeed will experience and have been experiencing inflation. So I'm breaking rank a bit with Jim Rickards here in this video and siding a bit more with Peter Schiff. Now I'll explain a little bit shortly as to why that is. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism right on out there to the masses to bring more people into precious metals. Okay, so we have to start here. Much of the dispute on the whole inflation versus deflation debate can be settled by using this formula right here that you're looking at on the screen. It is the quantity theory of money. Now, much of this debate can be settled simply by looking at the left side of the equation. You have M, the total amount of money in an economy, which can be printed to oblivion like we've seen. And you also have V, the velocity of currency. Now, let's do a quick example. If M equals 1 and V equals 1, then that means the right side of the equation would equal 1. All right. We passed third grade. Now, 1 times 1 equals 1, obviously. But if we decided to print heaps of M, and now M equals 3, for example, then the right side of the equation is 3. Now, let's say as M equals 3, the velocity gets reduced to 1/2. That means the right side of the equation equals 3 over 2, or 1.5. Now, that scenario is the main point of contention between inflation versus deflation in that debate. If V falls, then surely we are in deflation. That's actually incorrect if the amount of money printed is so much so that the right side of the equation, which is actually considered to be domestic inflation, you might have heard of the GDP deflator, if that actually increases. Now, let's take a look here at what Mr. Rickards had to say about all of this. Because honestly, my thinking runs contrary to his because of the following. This is how long the bubble will last. Let's get into what he has to say. The underlying economy, US and global, has a strong deflationary bias. Central banks can't tolerate deflation, so they respond with inflationary measures such as money printing, zero rates, and guarantees of all major securities markets. Those policies won't actually cause inflation for reasons explained below, but they will cause bubbles in certain asset classes, especially stocks. There's a serious question as to whether the central bank inflationary measures will actually work. They won't. Powell can talk all he wants about asymmetric inflation targeting and letting the economy run a little hot for longer than expected, as he did in his Jackson Hole speech on August 27th. But he doesn't actually know how to make inflation happen. As I've stated repeatedly, money printing alone doesn't cause inflation without velocity. And right now, velocity is dropping sharply as it has since 1998. Now, Jim's right, but if you introduce enough currency via the printing presses at the Federal Reserve, it would outweigh the effects of a declining velocity. So, if that's the case, Black Bullion, where does all of that currency go that was printed? Well, it actually goes here. Here's that quote. You see that quote in the red. So where is the inflation? It's in asset prices. In this past decade, it went into asset prices. Jim Rickards agrees that asset bubbles exist, but he doesn't seem to consider them a reflection of inflation. Now, to me, that may be a problem because as we've been hearing a lot of talk about, things like K-shaped recoveries and K-shaped economies, the interesting thing to note is that we've actually been living in a K-shaped economy for some time now, especially after the Great Recession. The rich got richer and the poor got poorer. And what did the rich do with their money? Well, you're looking at it on the screen. They poured it into equities. Now, here's the other thing too to take into account. Remember that only a fraction of the U.S. economy even owns equities. Take a look at this. A whopping 84% of all stocks owned by Americans belong to the wealthiest 10% of households. And that includes everyone's stakes in pension plans, 401ks, and individual retirement accounts, as well as trust funds, mutual funds, and college savings programs like 529 plans. For the vast majority of Americans, fluctuations in the stock market have relatively little effect on their wealth or well-being for that matter. And like clockwork, gold reacts to this inflation pretty seamlessly by going from $35 in 1970 to $2,070 by 2020. So guys, the moral of the story here is that inflation never actually went away. It just got picky as far as where it decided to lay its head. Now, let me know what you guys think as far as what side of the debate you're on. Are you on the inflation side? Are you on the deflation side? Do you think that, we have inflation, but it only exists in asset bubbles? Do you think inflation just exists, just in general? I should actually say that yes, we do have inflation in asset bubbles, but you actually do see inflation pretty much all over time. It's one of the reasons why you can say, well, hey, gas was 90 cents back in the day. Why is it $3 now? Or hey, this burger used to be $2 back in the day. Why is it $5 now? Eventually it will seep into the rest of the economy, but we see a lot of it right now within asset bubbles. So that's where I stand. Let me know where you stand. Guys, hit that like button, hit the subscribe button if you're new. It's Black Bullion for goldandsilvertoday.com.